All right, part two of chapter three, the bond chapter, which is all interest rates and discussing the term structure, what that is. So the term structure of interest rates is defined really as taking one particular security and creating in essence, what we call a term structure, but in essence, a graph of all the different traded securities and what they're trading at, meaning their yield. And from that, we can figure out, in essence, create the term structure, which allows us to see what interest rates are expected to be over some period of time. So, for instance, usually the term structure of interest rates, we're really talking about the U.S. Treasury, since the Treasury is the safest financial security. That the one interest rate throughout the economy that we tend to pay attention to is the Treasury yield, the U.S. government Treasury yield. And the Treasury has 3 months, 30 days, 1 year, 2 year, 5 year, 7 year, 20 year, 30 year bonds. And the reason why we pay attention to it is because all other interest rates in the economy tend to ratchet above the Treasury, right? Because the Treasury is the safest security, it's the most liquid security. So as a consequence of it, every other interest rate will be above the U.S. Treasury. So if the point being, if the Treasury moves, then all of moves up or down, then all other interest rates respond to that. Okay, and so here's just two examples, right, of what the yield curve looks like traditionally, right? The blue line we call an upward sloping yield curve, which is normally the case, right? The yield curve is normally upward sloping, right? And that just means that as time goes on for the maturity of a bond, the interest rate is higher, right? So, and that's generally true. So all else equal, right, a 30-year bond is going to have a higher interest rate or coupon than a 20-year bond, and a 20-year bond is going to have a higher interest rate than a 10-year bond, right? The longer you allow someone to borrow from you, the more you expect to be compensated. So generally speaking, the yield curve is going to be upward sloping because of that time issue, right? The more time that I allow you to borrow from me, the more I expect to be compensated. That's generally true. Okay. Actually, let's assume that's almost always true. Okay, so the normal yield curve tends to look like the blue line. Occasionally, though, the yield curve does this, where shorter term rates are higher than longer term rates. Right? We call this an inversion, and this will come up again in a minute. So just realize, right, what an upward sloping yield curve is, right, and what a downward sloping yield curve is. Meaning, what do we expect to happen to interest rates over the next 30 years? We expect them to go up. What's happening here? We expect a slight decrease in interest rates. Okay. Generally speaking, the yields, shorter-term bonds the yields on shorter-term bonds can tend to be more volatile than that of longer-term bonds. And I already gave you this, longer-term bonds have higher yields. Okay, the point of talking about the yield curve, the term structure of interest rates, we call that the yield curve. That the reason why we talk about it is because of the fourth dot here, right? The yield curve, we can infer what current expectations are of future interest rates from the yield curve, right? So this is why, in essence, we're talking about the term structure of interest rates, because it gives us an idea of the expectation of future interest rates. Okay, so there's a couple of theories about the term structure. The main one that we pay the most attention to is called the expectations theory. And all it means here is that back to kind of efficient markets, everyone knows the information, then in essence, embedded in a longer term, let's say bond, are expectations of future bond rates. So for instance, right, the 2-year yield on a bond should be equivalent to the 1-year yield on a bond and the expected 1-year rate 1 year from today, right? So in essence, the point is you should be indifferent between buying a 2-year bond. If we're looking today, you should be indifferent between buying a 2-year bond or buying a 1-year bond right now, holding it for a year, and then buying another 1-year bond. The two returns of those two will be the exact same in theory. Okay, the point here is we can take that out further. What that means is basically that the 5-year is approximately the average of 5 1-year bonds, and then that the 10-year is the average of 10 1-year bonds. Right? So if that's a little confusing, it looks like this. What it's saying here is inside of a 3-year, see if we can focus here. Right, inside of a 3-year bond, right, is equivalent of a bond from 0 to 1, and then another bond from 1 to 2, and then another bond from 2 to 3. Right, there's an interest rate 1 here, there's an interest rate 2 there, there's an interest rate 3 here. Right, and the expectations theory is that you're indifferent between buying this one bond or buying 3 1-year bonds. Right? We call this one the 1-year forward rate. One year from today. There we go. All right, and we call this one the 1-year forward rate 2 years from today. Okay, the point being here is embedded in a 3-year bond are the expectations of 3 1-year bonds. And so that means here, for instance, you could have a situation where if the 1-year rate is 4% and the 1-year forward rate 1 year from today is 5%, and the 1-year rate 2 years from today, these are estimates, is 6%, right? Then the yield on this should be the average of these 3 1 years, which is approximately 5%. Okay, that's the point of the expectations. That's one of the points of the expectations theory. Okay, and so this graph is meant to illustrate that, really. It's just that embedded in the 5-year is a 1 year. Notice the lingo here. It's the expected 1-year return in year 2, the expected 1-year return for year 3, and on. Okay. So in essence, the yield on the long term is the geometric average of all the the expected short term. Okay. So the point of talking about the yield curve is that it gives us a forecast of future rates. Okay. And so typically speaking, we already know that if the longer out in time you expect to be compensated with a higher interest rate, then what does that generally mean? It means that investors typically are expecting interest rates to at least remain the same and rise slightly depending on the slope of the yield curve. All right, and that liquidity premium that it's talking about here is, in essence, what is this saying? Why is the yield curve normally upward sloping? Right, there's 2 reasons why. One is because of the reason why a 30-year mortgage has a higher interest rate than a 20-year mortgage than a 10-year mortgage. That's that liquidity premium. That's what that's talking about, right? And the other reason why the yield curve could be upward sloping is that interest rates, those short-term interest rates, back to what I just drew out a minute ago, are expected to rise. Okay. So in a minute, we're going to go through a couple of examples of yield curves, but the reason why we care about these, and these are important and for exam purposes, is that it allows us to think about general economic conditions. Okay, generally yield curves are higher. Generally the yield curve is upward sloping. That's normally what the economy looks like, but it helps us to infer what's happening in the economy, right? It is incredibly important forecasting tool. We use it a lot to look at it. We can infer what the expectations are of economic growth. So let me stop there for a moment. How this works. Interest rates usually move with economic growth, generally speaking. When there is robust economic growth, interest rates tend to increase. Okay, and the reason why is, right, if companies are expanding and they're hiring more people, aggregate wealth increases, people spend more or consume more, and so the demand for dollars increases. If the demand for dollars increases, interest rates will go up. That's the cost of money, right? Interest rates are the cost of money. So as all else equal, if you don't increase the supply of money and interest rates, but the demand for money goes up, the price of money is going to increase. The price of money is the interest rate. Okay. So the next few slides have a bunch of graphs, I believe, that going to show you how the yield curve is generally a good predictor of where we are in the economy, right? Generally speaking, if we think about the long end of the yield curve, when I say long end of the yield curve, I mean 10 years of maturity or higher, right? During an economic expansion, the long end tends to increase. So in essence, if it's upward sloping, normally the rate of change at the long end of the yield curve is steeper, right? An inverted yield curve we'll come back to, but the reason why inverted yield curves are important, okay, an inverted yield curve means the short-term rates are higher than longer-term rates. That's the first graph I showed you, this thing right here, April 20. That's an inverted yield curve. Okay, the reason why what it's saying, right, is that short-term rates are for whatever reason higher, higher than longer-term rates. And that if we're looking at August 2000, what is this saying? It's saying that we expect the interest rates to come down over the next few years, right? And that long-term rates are expected to be around 6%, a little above 6%. Okay, so here's a bunch of graphs. We're going to talk about this. So we pay attention to what we call a term spread. A term spread is the difference between the 90-day T-bill and the 10-year T-bill. So the 90-day is in blue, the 10-year is in black. Notice that the short term is more volatile relative to the long term. Okay, and then the dotted line on the bottom is the difference between the short and the long. Okay, now what's important is that when it's negative, right, it dips below zero, what that means is there's an inversion, meaning short-term rates, and you see it right here, right? Short-term rates in 74, short-term rates are higher than longer-term rates, right? What you should notice is that in yield curve, inversions do not tend to persist, okay? But they happen periodically. 74, twice in the early 80s, it happened in 9/11, and it happened in the financial crisis. So those four instances alone should tell you why we care about inversions. The inversion of the yield curve tends to predict recessions. Okay, when the economy is generally good, right, and you can kind of see this here, right, as an example. High interest rates typically aren't great for growth, right? As the interest rates come down, or how do we get the economy moving generally? The way we get the economy moving is by decreasing rates, decreasing the cost of money in essence. By decreasing rates, more people can borrow, or more businesses, I shouldn't say people, more businesses can borrow, stimulating economic growth. So every time we have a slowdown, traditionally, the recipe has been, over the last, let's say, 30 years, the recipe has been, let's reduce interest rates such that if we reduce all borrowing costs, businesses will be more adept or more likely to invest, thereby increasing economic growth. Okay. So I pulled this one from a different book, but it's a good graph that really illustrates. Remember, I told you term spread is the 10-year minus the 10-year minus the 90-day. Okay, and then there's GDP growth. GDP growth is the red line, and you see, we can make this larger. The green line is the term spread, and what you notice here is that they are related. And notice the brownish blocks are recessions, right? And what did you notice, right? There's an inversion here, recession. Inversion, recession, right? It came back up. There was another reversion, recession, right? Only in 92 did we have a downturn without a recession, right? This is not quite 9/11, but this is 9/11 right here. We were already in recession, right? An inversion in 2007, I believe, and then we had another recession, okay? The point here is, and if I look down the graph, is that what these two graphs do is the bottom graph basically slides GDP growth, it slides the yield term 1 year forward, right? And what you see is that they overlay each other, meaning that that inversion of the yield curve where the short-term interest rates are higher than the longer-term interest rates tends to predict recessions in about a year before they happen. This is why inversions matter. Now, why does that happen? Right, back to the economic growth argument here. Right, let's assume everyone's working, or most who want to work and find a job. That means labor markets are tight, which pushes upward pressure on wages, right? If everyone has a job, the only way you can get me to move out of my job is to compensate me with a higher wage. So wages tend to go up in tight labor markets, generally speaking, which means the prices of everything are going to go up. That's inflation. right? As prices go up, purchasing power goes down. And what happens is the economy is growing too fast. And so interest rates are increased. This is the counterintuitive part. Short-term interest rates, think about the short end of the yield curve. Short-term interest rates are increased to slow down the economy, right? We want it to keep growing. It's just growing too fast, so we raise interest rates to slow the growth. And that's what causes the inversion of the yield curve. A short-term period, let's say a year, 18 months maybe, if that, where interest rates, short-term interest rates are higher than the longer-term interest rates. Because remember, a 20-year interest rate is approximately the geometric average of 21 years, right? So that's what causes the inversion, a period of higher short-term interest rates that will ultimately level off over the near term, the next 10 years, let's say. So you have to know what a normal yield curve is. You have to know what an inversion is and why an inversion is important. I don't know why it keeps doing that. There. Okay. So I gave you this already, right? When term spreads tend to fall, meaning the yield curve is inverted, GDP growth tends to fall as well about a year later. That's why we pay attention to yield curves. All right. The one thing it clearly didn't predict is the financial crisis of 2007 that we talked about a little bit earlier. That's one of the ones that it did not predict. And that's a severe economic exogenous of impact, right, are much harder to predict for the yield curve. Okay, so there's like 4 different graphs on here. These are on here to talk about the interpretation of it, right? Each one of these is different. Okay, so for instance, and again, remember, you don't typically have high interest rates typically without growth, right? Generally, what drives the interest rate environment is economic activity. The more economic activity there is, the more demand for dollars there is, the higher the interest rates are, generally, right? Our long-term rates typically, and this is why this is on here, just to give you a frame of reference, right? In the late 80s, right? Pay attention to the long end, right? I don't want you to pay as much attention to the short end for this part, but look at the long end. 10 years, meaning, right, the 10-year treasury rate was above 8%, which means mortgage rates were about 9% in the late 80s, okay? But even at 8% suggests, right, that there was robust economic activity. Now go to 2000, and you look at 2000, and what's happening? Interest rates are lower, right? And there was an inversion that occurred early on. So hence we had which tended to predict the the recession that was coming. Then let's jump to 2006. After 9/11, what do we see? Interest rates are low in 2006, right? Compared to 89, compared to the 90s, the long end in the 89-90 was 8%. The long end of the yield curve, right, was 4.5%, meaning you could get a mortgage at about 5.5%, 5.5%. Right. The flatness of this yield curve tells you what? That at least there's not necessarily, there's consistent growth, but interest rates are fairly constant, right? The flatness of it. So that's what I meant by the curve of the slope matters, right? Notice here that that it's fairly flat. Okay, now let's move forward to 2012. And what do we see here? That interest rates are almost zero. And here's the interesting thing. Up to the 10-year maturity, right? The 10-year is 1%. The 30-year is 3%. historically low, which means in 2012 you could borrow at around 4% to buy a home. Okay, so this short end, the fact that interest rates are zero or at or near zero, right? And you don't see an upward slope that looks, let's say, like that. That's not a great slope, but work with me. Okay, right? These two slides or these two curves tell us something significantly different, right? What this tells me in 2012 is that at least this is the 5-year right here, right? So even a 5-year treasury is about what, 0.25%? And remember, the 5-year is the average of 5 1-years. So it's telling me that interest rates are going to be very low for the next, at least the expectation is the interest rates are going to remain relatively low for the next 5 years. Right? That generally, the only way you can get that is with a very low growth environment. If you're in an environment where the economy is growing, is robust and growing significantly, then you're not going to have a situation where the yield curve looks like the black line. You would hope that it looks more like the red line. But the point is the slope matters, right? This tells me that over the next 5 years, what's economic growth going to look like? Largely, not much, right? And indeed, fast forward 5 years, have we seen a lot of economic growth since 2012? The answer is no. Okay. If inflation historically is about 2%, right? Historically it's 2%, then interest rates should at least be above inflation. And so this says that the economic growth is very slow, this low level, right? And so the point of this is there's information to be gathered from the yield curve. When you see a low interest rate environment like this, it suggests, one, economic growth is slow, and that overall interest rates, even though as they're increasing here, keep in mind the scale. We're still talking a 30-year loan at 3%. Right, and this is what I gave about inflation, right? When the economy grows, right, this is post-World War II, right? Then we had a huge expansion in the early 60s that died in the 70s, 80s, we had a big expansion. And what have you seen? That inflation has declined and declined and declined. And so has economic growth. Those two tend to move together. You don't typically have inflation without economic growth. There are a couple exceptions to that. Okay. There's a rule called the Fisher effect. And the Fisher effect simply says a nominal rate, which is the rate we normally think of, embedded inside of a nominal rate of return are two parts. It's a real rate of return and the inflation rate. Okay, the Fisher effect. So if I rearrange this, it's really the 1 plus the nominal rate is equal to, let's show it. Right, the Fisher effect is basically that inside a nominal rate are two components. Right, there's a real rate and an expected inflation rate. Okay. If you do it as geometric returns, it's 1 plus n is going to be equal to 1 plus the real rate times 1 plus the expectation of inflation. Right? We approximate it this way, though, meaning if the nominal rate is 6% and the real rate of return is 3%, then the expected inflation, then it's obviously 3%. Right? We approximate this formulation of it that way. It's approximately the same. It's off a little bit. The point here is, over long periods of time, let's say 3 to 5 years, we assume that the real rate is constant. Okay? So, if we assume that, if for whatever reason interest rates increase to 7%, if interest rates increase to 7% and we assume that the real rate is constant through time, what's the reason why the interest rate is increasing? The reason why this is the nominal interest rate is increasing is because the expectation of inflation has now increased. This is what's driving changes in nominal interest rates. Okay? So in essence, what's the implication? Without inflation, you don't tend to have increases in interest rates. Okay, and what drives inflation, generally speaking? Economic growth. We need growth to generate the inflation. Without the economic growth, you don't get the inflation, you don't get higher interest rates. Which brings us back to where we are today. Today, interest rates are very low, right? And the question is, when are interest rates going to increase? Yet one of the problems is that the economy, U.S. economy, has largely not grown, has not had robust growth relative to 20 years ago. Okay, and I think it was in this class I showed the savings rate after 2007, the financial crisis. The savings rate in aggregate has actually increased, right? So that's great from the standpoint of people are deleveraging. The problem is that we need people consuming to increase economic growth, right? So if people are saving more, they're not consuming as much, there's less economic growth in the aggregate. That means that there's going to generally be less inflation, and that relates to lower interest rates. Now, what have we seen recently? Right? We've seen commodity prices increasing. If you've gone to the store and bought meat, meat has increased significantly. Right? The question is, will this continue? All you have to do is go to the grocery store and buy something, and it's more expensive than what it was before, let's say, a year ago. That's inflation. Right? Now, the question is, what's driving that inflation? Right? Most experts, in air quotes, most experts would suggest that the increase in food prices that we've seen recently is a function of increased government assistance. All the checks that have gone out to people, et cetera, that economic growth is, I hate to say stagnant, but it's about where it was before the pandemic. So in essence, what's driving the increase in prices, right? This is economic growth generally causes that. Most would say that economic growth has not largely picked up. So what's caused this increase? Right? The government sending checks to everybody. And so the argument goes that as these checks diminish and go away, in theory or in hope, that the inflation that we have recently seen is transitory. It won't last much longer. That's the argument. We have to watch and see what happens. Right? And then another thing that we've seen happen is what's driving some of this inflation, current inflation. Right? Housing prices have increased significantly in DFW over the last 6 months. That's one thing. Right? Government stimulus is the second thing as well. Right? what else has caused this increased price? Oh, one more thing. There's a global chip shortage, right? Which is what's happened to new cars, right? Has slowed down dramatically. But over the last 3 to 4 months, the used car market has exploded, right? So when I'm saying sources of inflation, what's driving some of these things? It's some combination of all of these things, right? The chip shortage has caused inflation in the in the used car market. The low interest rate environment has helped to cause housing prices to increase. There's not a lot of inventory in housing because hopefully most home builders learned from 2007 and aren't just throwing up houses. Instead, they're waiting. So there's a backlog of houses being built. And then probably the most important one over the last year has been multiple rounds of government stimulus. So the argument goes is that these are the things that have helped to drive inflation and short-term inflation, and that they will not persist. Whether they will or won't is to be seen. Okay. So, right, what's the point? If you invest in a security that pays 10% annually, that pays 10% annually and inflation is 6%, right? What's the real rate? It's approximately 4%. It's a little less than that when you do the geometric return. Okay, but the broader point of learning this relationship between nominal, real, and expected inflation is that generally speaking, we assume the real rate is constant over intermediate periods of time. The point is, if nominal interest rates are changing, they are changing because people's expectations of inflation are changing. Right? That's what you need to get from this. You don't have to worry about tips. Let's see, what else do you need? Oh, I guess the last part of this, which is talking about default really quickly, is just that realize if treasuries are the risk-free asset, they're going to have in terms of term structure, they're going to have the lowest interest rates, right? And so then if we think about your firms, the riskier your firm, the higher the interest rate it pays, right? Every other interest rate ratchets off of the treasury. So if for whatever reason U.S. treasuries go up, everyone else's interest rates go up above that. And I think that there's a graph that illustrates this. Okay, this is just an example of AAA's, right? The rating will tend to equate to yield to maturity. So, for instance, you see this and you'll say, wait a minute, how is it that J&J's coupon is 6.73%, but yet Freeport is borrowing at less than 1%? Like, how is that possible? Well, what you don't know is when this J&J bond was actually issued. And since it was 6.3%, this bond is probably really old. This is probably like a 20-year bond that was issued in right after 2000, something like that. Whereas this is more than likely, almost assuredly, this is a new bond. Because once we look at the ratings, AAA is the best, BB is still investment grade. Anything below B is what we call junk bond status. These are really risky, right? So we don't pay attention to the coupon, we pay attention to the yield to maturity, right? The yield to maturity reflects the default risk, okay? And so if you look at J&J, it's AAA, and you see going down the default risk, these are measures of, right? That's where the yield to maturity comes into play. So that's another reason why we don't pay attention to this coupon. We pay attention to the yield. Let's see what else. It just goes through the different bond rates. Oh, here we go. This is good. Okay, so this last graph is meant to show you here's the difference between corporate bonds and the Treasury. Okay, the blue line is the spread between the 10-year corporate top-rated bonds. The red line is the spread between B-rated bonds, subtracting out its yield from the Treasury yield. Okay, the point behind this is that when times are good, think about it, the times are good, everyone's working, businesses are making money, then the risk of default for the riskier bonds diminishes, right? So all else equal, without knowing anything, I know when the good times generally are because you see the spread between these two decrease significantly, right? Anytime there's a recession, you see it widen, right? And so I know where recessions are just by looking at the spread between the two. There must have been a recession here and a recession here. That's when that inflation was high, and then it happened again in 80, and then again in 82. That was the second recession. When the economy is doing well, what do you see happen? The difference between these two tends to diminish, right? Okay, and then, right, 2008 happens, and look what happens. The spread between the two explodes. The point here is in bad times, it's harder for companies that have, it's harder for riskier companies to borrow, right, because default risk increases, right? And all you have to do is think of COVID and think about what's happened to the default risk associated with companies who had to completely shut down. The default risk has increased, so their ability to borrow has become much more costly, okay? All right, so bonds, valuing the bonds, understand the inverse relationship between bonds and market interest rates, know what the term structure is, know what an upward sloping yield curve is, know what an inverted yield curve is, know why the yield curve is important, why the inversion is important, why do we pay attention to yield curves at all, or the term structure of interest rates, why does it matter, and the Fisher effect, right? Knowing that when nominal interest rates change, what's generally driving the change in nominal interest rates, or let's back up, what's embedded inside a nominal interest rate? A real rate of return and an inflation expectation, at least for the Treasury yield curve. So if nominal rates are changing, why are they changing? Because inflation expectations have changed. That's the key there, all right? That's chapter 3.